Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
So let's dive right in. We're looking at the intellectual complexity surrounding Chevron Corporation, ticker CVX, as we head into 2026. And specifically, we're debating the primary driver of its current valuation premium. The stock has been, well, pretty volatile, trading recently between about 156.35 and 163.85. But the real story here is a significant, almost immediate market reaction. Following the news of Nicolás Maduro's capture on January 3rd, the CVX stock jumped, 5.1% on some pretty substantial volume. It just dramatically outpaced its peers.
Right. And that immediate divergence from the competition, you look at ExxonMobil, XOM, it gained only 2.2%, and ConocoPhillips COP was up maybe 2.6%. That really puts a fine point on the central question we have to address today. Is the current premium valuation, which is sitting around, 11.6 times forward PE, is it driven primarily by this non-replicable headline-grabbing phenomenon that we're calling geopolitical alpha, or is it something a little more fundamental?
And I'm going to argue that it is the geopolitical alpha. I think this unique Venezuela catalyst is the true engine driving the premium. To be clear, when I say geopolitical alpha, I mean the non-replicable strategic advantage and the implicit political de-risking that CVX has achieved. It's because of their persistence, their established relationships. They've essentially positioned themselves as the logistical arm of U.S. reconstruction efforts in the region. And that is what currently distinguishes Chevron in the U.S. major space.
See, I come at it from a different angle. While that geopolitical narrative is powerful, I think it's mostly sentimental. I believe that the stability, which is derived from a kind of radical structural efficiency and long-term portfolio fortification, is the actual sustainable foundation that justifies that high multiple. And when I say structural efficiency, I mean the verifiable success in reducing operating expenditures and integrating major low-cost assets that fundamentally lower the company's long-term break-even price and, solve their reserve replacement challenges.
Well, look, the market is unambiguously pricing in a Venezuela premium. And why? It's because Chevron is the last major standing. The Trump administration's intervention has positioned the company in a very unique way. And we saw this quantified immediately in that 5.1% stock divergence. These legacy Venezuelan assets, which were frankly financial anchors before, are now being viewed as potential growth engines. And it's a reward for CEO Mike Wirth's strategic patience. So this isn't just a political bet, it's a financial one. The stock is, I think, rightly positioned as a strategic asset, a geopolitical hedge that protects investors from broader regional volatility, all because of this implicit government backing.
I agree that the market's reacting to headlines, but for me, geopolitical alpha is purely sentiment-driven. Execution, on the other hand, is permanent. The real long-term justification for the premium is the successful structural transformation they're undertaking, the efficiency story. CVX is in the middle of executing a massive 15 to 20% global workforce reduction, and it's specifically aimed at realizing $3 billion in structural cost savings by the end of 2026. This isn't just marginal trimming. This fundamentally de-risks the entire enterprise, making sure it can operate profitably even if global oil prices dip down toward, say, the $50 per barrel range.
But that internal structural story, while important, it's M&A playbook stuff that any major could attempt. The geopolitical situation is exclusive to Chevron. And furthermore, you can see the institutional confidence in CBX's strategic positioning reflected in the microstructure. The remarkably low short interest, just 0.95% of the float. It confirms that the professional money is not betting against this story. They see the fortress status.
On the contrary, if we're going to talk about structural fortification, let's look at the Hess acquisition. That move secured a 30% interest in the Stabroek block in Guyana, which is a massive, low-cost asset that solves the fundamental long-term reserve replacement problem. It allows CVX to strategically diversify away from high-decline Permian shale assets. Now that is structural efficiency in action. And that dividend, currently yielding, 4.2 to 4.5%, that creates a structural barrier to speculative short selling because of the immense negative carry penalty. That is a real defensive structure against casual speculation.
Okay, but let's focus first on the timeline reality of this geopolitical premium. Because that 5.1% jump suggests an immediate cash flow impact, and well, I believe that is misleading. The jump is based on political rhetoric alone, not engineering reality.
Venezuelan infrastructure is severely dilapidated. It suffered from decades of underinvestment. We know from the engineering reports that restoring production to its historical peak of, say, 2 or 3 million barrels per day requires tens of billions of dollars in sustained capital expenditure.
I see why you'd think that. And I agree that the full production ramp is a long-dated proposition. We're probably talking a 5 to 7 year effort for peak output.
Exactly. So meaningful free cash flow, FCF, accretion from Venezuela is realistically a 2027 or 2028 story, not a 2026 valuation driver. The stock is being priced for perfect execution right now, leaving zero margin for the inevitable logistical and political quagmire that comes with restructuring a state-owned oil entity. So investors paying 11.6 times P today are paying for perfection years in advance.
That's a compelling argument, but let me reframe that risk. You're focusing purely on the future production ramp. The immediate verifiable benefit is the security of existing cash flows, and that justifies the immediate price movement. Just ensuring those current exports of 150,000 to 240,000 barrels per day are fully secured, paid for, and critically, the removal of the catastrophic expropriation risk provides immediate, substantial financial certainty. The discount that was previously applied to those assets has been removed overnight. So the market isn't just buying a distant cash flow stream, it's buying the right to the first mover advantage in Venezuelan restructuring. That strategic asset class distinction, the only U.S. major to have maintained its footprint, that is the alpha we're discussing.
But this first mover advantage is purely optionality, not realized earnings. The stock is trading at an 11.6 times multiple, while European majors like Total Energies are trading closer to 7.6. That 4-point spread implies the market sees Chevron management as fundamentally superior allocators of capital, capable of delivering FCF immediately. If the Venezuelan optionality doesn't mature until 2027, then the current premium has to be supported by something else, the guaranteed savings from structural efficiency.
I agree the efficiency measures are factored in, and they are critical. The workforce reduction is, as I said, necessary M&A playbook, elimination of redundant roles post-Hess to achieve the stated goal of being a flatter, faster organization. And Wall Street does reward this ruthless efficiency, hence the 11.6 PE. That 4-point gap over their European rivals signals market confidence that management will capture those $3 billion in structural cost savings, leading to sustainable margin expansion regardless of immediate oil price volatility. The market is betting on the operational discipline.
I'm sorry, but I just don't buy that the operational discipline is without risk. Let me tell you why. Cutting 15 to 20% of the global workforce risks a significant brain drain and the loss of critical technical expertise, particularly when you're integrating something as complex as the Stabroek Block. Just think about the complex engineering environments, deep water drilling in Guyana, high-pressure refinery operations, or even the technical expertise needed to restore complex legacy Venezuelan fields. Losing experienced hands can lead to catastrophic operational continuity failures or safety incidents that could entirely wipe out that $3 billion in salary savings.
That is a fair point regarding technical talent retention. How then do you reconcile the internal execution risk with the fact that these efficiency measures are almost universally celebrated by analysts? It seems the street views the cuts not as a risky brain drain, but as necessary surgical optimization.
Because Wall Street focuses on the announcement of savings, not the reality of morale. The juxtaposition of announcing multi-billion-dollar share buybacks while firing up to 20% of the staff creates what internal forums are calling a mercenary culture. This internal pressure is a profound execution risk. If key personnel leave, the deep water engineers, the reservoir experts, then CVX's ability to maximize the Stabroek Block asset, which is central to your structural argument, could be compromised. The execution risk of managing this morale crisis has to be accounted for in the valuation.
Okay, let's turn to the microstructure then, because it offers a quantifiable measure of external confidence. My argument is that the short interest analysis is overwhelmingly bullish for the long thesis. The short interest is only 0.95% of the float. The short interest ratio, the time it would take to cover those shorts, is between 2.01 and 4.24 days to cover, which is extremely low.
I agree that the short interest is low, but the location of the shorting is also important.
Precisely, the high off-exchange short volume, 46.01% of the total, confirms that this shorting is mostly structural hedging. This is the routine delta hedging by market makers managing index exposure or options books. It's not a fundamental short signal on the underlying business. The smart money is actively choosing not to bet against CVX. They are respecting the implied geopolitical floor.
That's a compelling argument regarding the lack of fundamental short sellers. But have you considered the resulting pain trade asymmetry? Given the extraordinarily low short interest, a short squeeze is, well, mathematically unlikely to be the primary driver of price appreciation. The stock is already crowded with longs, so the real asymmetry is to the downside. If the Venezuelan narrative stalls, or if oil prices retrace by just $10 or $15 per barrel, the lack of a substantial short cushion means there will be very few natural buyers, no short coverers, available to absorb a liquidation of those crowded long positions.
So are you suggesting we're standing on a liquidity precipice if sentiment shifts?
Essentially, yes. The absence of a downside defense exposes the stock to significant liquidity risks during a broad market pullback. The structural defense provided by the dividend is strong, sure, but it can't absorb a mass liquidation of long-only funds who bought purely on the geopolitical hype. This asymmetry is what justifies the technical bear case target of $152, suggesting the premium is fragile. The very low short interest that you cite as a bullish signal also removes a potential source of buying pressure during a downturn.
But that fragility assumes the geopolitical floor disappears, and I maintain that floor is solid. The exclusivity of CVX's positioning, being designated as the logistical arm of U.S. foreign policy, combined with the long-term, low-carbon, low-cost barrels secured in Guyana through Hess, it justifies CVX's status as the best-in-breed U.S. major. Its multiple reflects both strategic positioning and its dividend aristocratic status. The market is paying for exceptional foresight and the resulting barriers to entry.
While the geopolitical narrative is undeniably compelling, the reliance on high-risk execution, both internally in managing the morale crisis from the 15 to 20% workforce reduction, and externally in restoring dilapidated Venezuelan infrastructure, means the current 11.6 premium is built largely on execution risk, not confirmed cash flow. If those efficiency measures fail to deliver the promised $3 billion in savings, or if the Stabroek integration faces technical hurdles due to brain drain, the stock will rapidly contract toward the cheaper European peer multiples of 7 to 8 times. The risk-reward here leans heavily toward the risk side due to the compressed downside support.
We have explored a fascinating tension today. On one side, we have the immediate sentiment-driving political premium generated by the Venezuelan news, evidenced by that 5.1% price jump, which gives CVX an exclusivity no competitor can replicate.
And on the other, we have the immense, long-term, high-stakes operational success required from the Hess integration and the deep internal cost cuts to structurally justify that current valuation above 156. The fact remains that CVX's management must navigate profound cultural disruption internally while simultaneously dealing with an uncertain, multi-year, multi-billion-dollar rebuild externally in Caracas.
So the core tension really lies in determining which driver, geopolitical alpha or structural efficiency, will ultimately define the long-term premium. The final determination of which factor is more significant remains an open question, and it's rooted entirely in how well CVX executes against the backdrop of both political support and these challenging internal structural realities.
Exactly. And investors must reflect on their own risk tolerance for execution failure. Considering the unique geopolitical tailwinds is necessary, but so too is assessing the challenging internal structural realities when calculating the true long-term viability of CVX's premium status.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.